Okay, and now we have another supply and demand curve analysis question. So this comes from Krugman Wells, Microeconomics, Second Edition, Chapter 3, Question 12. The question is as follows. The accompanying table gives the annual U.S. demand and supply schedules for pickup trucks. So pickup truck, these are the prices. So at $20,000, we're saying that the quantity demanded of trucks is 20 million, while the quantity supplied is 40 million. At $25,000, quantity demand is 18, quantity supplied is 15. $30,000, quantity demand is 16, quantity supplied is 16. And at 35,000, we have quantity demanded of 14 million and quantity supplied is 17 million. And then lastly, at $40,000 for the price of a truck, quantity demanded is 12,000 and quantity supplied is 18,000. So plot the demand and supply curves using these schedules and indicate the equilibrium price and quantity on your diagram. So first off, just looking at this, you could tell where the equilibrium price and quantity is going to be. The definition of equilibrium price and quantity is where quantity demanded equals quantity supplied. So at $30,000, the quantity demanded is 16 and the quantity supplied is 16. So here you have buyers and sellers perfectly matched at the same quantity at this price. If the price was any lower, you'd find that the quantity demanded exceeds the quantity supplied, and then you have a shortage. At any price higher, at 35 or 40,000, what you'd find is that there's the quantity supplied is greater than the quantity demanded, and you'd have this surplus, this excess these excess trucks sitting on the market. In this situation, when price is high, you have all these excess trucks, so it's in the interest of those truck selling firms to decrease their price and bring it down closer to here. And then with the prices low and with quantity demanded higher than supplied, there's an incentive for these firms to increase price to bring the quantity demanded equal to quantity supplied. So I mean, even without drawing the diagram, you can see what the equilibrium price and equilibrium quantity is going to do. However, drawing it, we can. Let me see if I could do that easily for you. Let me draw the diagram. One second. Okay, well, I didn't exactly draw the diagram, but I found posted online someone who'd drawn the diagram for me. So here I've just taken the schedules, so you can see the prices of 40, 35, 30, 25, 20, going all the way down. We did the demand curve, which is the downward sloping curve. At a very high price, you have low quantity demanded. At a very low price, you have a high quantity demanded. And then I drew in someone else drew in the supply curve here. At a very high price, you have a high quantity supplied, 18 million, and at a low price, you have a low quantity supplied, 14 million. And then once again, you can see the equilibrium price and quantity here is going to be 30,000 and 16 million trucks produced. Okay, so going on to part B, suppose the tires used on pickup trucks are found to be defective. What would you expect to happen in this market for trucks? And then show this on a diagram. Well, clearly, if the tires used on these pickup trucks are found to be defective, that's going to be an inward shift in the demand curve. Basically, at every price for a truck, there's going to be a lower quantity demanded because, shoddy tires are, not a particularly attractive thing. So again, at every price, there's going to be a lower quantity demanded. So that's going to reflect an inward shift in the demand curve. So this demand curve here is going to shift inward. Let me draw that for you, or find a drawing for you. Just one second. Right, so here's a drawing. You can see there's an inward shift in the demand curve. And that inward shift in the demand curve, you have the new equilibrium. So you start from equilibrium 1, you go to new equilibrium. The new equilibrium is associated with a lower price, which is clearly demonstrable, and then a lower quantity in this market. So with the defective goods, you have fewer trucks bought and sold at a lower price. And that's simple as that. Turning to part C. Okay, part C asks, suppose that the U.S. Department of Transportation imposes costly regulations on manufacturers that cause them to reduce supply by 1/3 at every given price. Calculate and plot the new supply schedule and indicate the new equilibrium price and quantity in your diagram. Just one moment to do that. Okay, so here we've done it. We have the prices of trucks, once again, starting from 20, 25,000, 30, going up. The quantity demanded of trucks is identical, but the quantity supplied of trucks has been decreased by 1/3. So where before associated with $20,000 for a truck, it used to say quantity supplied was 14 million. Now it's 9.3. Where before it said 15 million, now it's down to 10. Where before at $30,000, the quantity supplied was 16 million. Now it's down to 10.7. This is decreased to 11.3 million, and then associated with $40,000 truck, the quantity supplied is 12. So once again, it's asking, what's the new equilibrium price and quantity? The equilibrium price and quantity is where quantity demand is equal to quantity supplied. So the equilibrium price is going to be 40,000, and the equilibrium demanded is going to be 12 million. So drawing that, or I found this posted online. You have the price of truck on the vertical axis. You have quantities of trucks once again drawn on the horizontal axis. Where before you had the demand curve over here and the supply curve, with the new restrictions and the inward shift in the supply curve, because at every single price we're told that the quantity supplied was decreased by 1/3. You have this inward shift in the supply curve going from S1 to S2. You now have the new equilibrium price and quantity at 40,000 and 12 million. And that's it. Thanks.